Thank you for joining us. Our presentation today features Joe Ramos, head of Lazard's U.S. Fixed Income Team. Please note the information and opinions discussed today do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll hand it over to you, Joe.
Today, the topic is going to be a little off the beaten path, if you will, and so I think it helps to speak about the framework that we use when we are managing money in the U.S. space for looking at macro pictures. From our perspective, our main and primary goal is to be able to meet the U.S. dollar obligations of our clients. And the way that we look at the world is not really from a top-down forecasting macro situations and running around and building portfolios around those forecasts. We actually look at the world completely bottom-up in my group, and it's the way I've managed money all my life. And so, when you think about what that means, we're actually looking at individual securities and building a portfolio that we think is a portfolio that survives through a variety of turbulent moments that can appear in markets. So for us, the macro picture really, if you think of this as a sailing exercise, is really the weather. And when we look at it, we like to think of our portfolio as being able to sustain the weather that we're sailing into. And we think a lot about the potential for changes in that weather that could be damaging to the portfolio. To the extent that we can avoid the weather, that's the best thing that can happen. But if we can't avoid the weather, we want to make sure that we sail through it and we get to the other side with as little turbulence as possible. And so the weather today, it looks peculiar. If you go to the next page, we have not been in a situation like this away from the United States that I have ever found or that I have ever experienced. Currently, if you look at the global aggregate index, which is all the investment grade bonds in the world that actively trade, 15 trillion of that index is trading to a negative yield. And the percentage that is trading to a negative yield has been as high as 30%. It's down now to about 26%. But every time in the world that there's fear, this graph gets more and more negative. And what has happened as a result of that is that we've been put in uncharted waters with regard to U.S. interest rates. If you go to the next page, you'll see here a long-term history of the U.S. 10-year Treasury rate. And fortunately, we have a lot of data on that, so I could go back all the way to 1925. And what you'll notice is that right now we are at levels that we were back in the 30s and the 40s. And those are very, very scary levels because, when we were there in the 30s and the 40s, if you look at the next chart, the unemployment rate was about 25%. And we then went from that into a world war. And so it was very, very justified to have interest rates as low as they were then because the circumstances that were surrounding us was so bad, so dire. If you go to the next page, you'll see that during that period of time when interest rates were last this low, we had negative nominal GDP. Now, most times we measure GDP in terms of real GDP, but real GDP only captures the buying power of the dollar. It doesn't capture the ability to pay back debt. Nominal GDP is really what captures the ability to pay back debt. So we've had a lot of recessions, as you know, since 1950 forward. But if you look at this graph, you see that nominal GDP has always been positive except for that little blip that you see, which is the 2008 crisis. And that's why the 2008 crisis was so scary. So the growth in earnings is very tied to mature companies to nominal GDP. Your ability to pay back your own individual debt is nominal GDP. And so, yes, you have money that's worth less if inflation is very high, but you still have money so you don't go bankrupt. And that is the key to avoiding of depression, not going bankrupt. And this is why when we saw that slight negative in nominal GDP, that Bernanke in particular reacted so strongly to it back in 2008. Now, the issue with this is that when we actually triangulate and look at other parts of the marketplace to see if, in fact, something bad is going on in the U.S., there's nothing bad going on in the U.S. Actually, if we would think of the U.S. as a sea, it's a sea of calm right now. If you go to the next page, right, we saw that nominal GDP on the prior page is positive. We saw that the unemployment rate is very low. And so another reason why interest rates would be so low is if people think we're going to go into some kind of deflationary spiral. And you can see here from historical CPI that historical CPI remains positive. But more importantly, the markets that trade CPI, which are the TIPS markets in the United States, on a 5-year forward basis are forecasting a positive result. I don't have it in these pages, but if you would look at the average of all economic forecasts out there, number one, they're all positive. Number two, they all revolve around a number very, very close to 2%. And so then, we had a little scare in the repo market recently where overnight rates went high because of a shortage of dollars. It certainly didn't bother me much because that used to happen all the time, but it obviously scared the press in particular. And so you wonder whether there's a unwillingness of institutions to lend to each other. On the next page is a financial lending conditions index that the Chicago Fed puts together. The pink part of the slide is recessions. You can see that when institutions don't want to lend to each other, this index is very high. This index right now is at a minus 0.65. It's as low as it gets, quite frankly. And so financial conditions are very easy. If you want money, you can get money. In the U.S., is everyone worried about a big default cycle? You hear the press talk about leverage all the time. And the reality of it is that people that lend in the marketplace are not worried about a big default cycle because even though leverage is higher than it used to be, revenue and earnings are much higher than it used to be too. So the debt that's on balance sheet at companies is very affordable. As you can see here, defaults forecasted by both J.P. Morgan and Moody's remain on the low side of history, and defaults have been on the low side of history. And actually, most of the defaults have been speculative in areas where we've seen speculation like energy. In terms of the majority of what makes up the U.S. market in terms of companies, which are mid-cap companies and small-cap companies in the United States, and high yield, all of them are quite healthy. So what's really going on here? And what's really going on here is that away from our country and the rest of the world, there's the equivalent of a superstorm brewing. It kind of reminds me of a Superstorm Sandy being from New Jersey, where all of these factors were colliding with each other and no one thought that it could actually happen, and it actually occurred. And so what's the issue? And the issue is Europe, a combination of Europe and China. Right? China is one of the largest demand factors in the world. Europe is one of the largest exporting parts of the world, of the continent, right? And so the key economy in Europe is Germany. And when we look at Germany, we can see that they have had a problem with inflation. The central bank has been targeting 2% forever and hardly ever gets there. But more importantly right now, German expectations, when you look at the expectations in terms of future inflation in Germany, the number is negative. It's a negative 1.1%. Then the other factor I would point you to is German GDP. Real GDP is at 0 year over year. But the real one that is scary is that nominal GDP is at 2%. Right now, manufacturing PMI in Germany is below 50. It's around 45. It hasn't been as predictive as it has been historically, but that number has been pretty predictive of a recession. The fear that I think is in the marketplace is that if there's a recession in Germany, it can likely lead to a negative nominal GDP situation, which will put pressure on bankruptcies and put pressure on the financial system. And so why is our rate so low? The tools that are available to the central banks away from us have been used fairly extensively, and they're at their capacity. The German 10-year rate is now at minus 31 basis points. The Japanese 10-year rate is now at minus 12 basis points. And these central banks have been pricing risk so low that they've been changing behavior. And as a result of the changing behavior, what's been happening is that they have been increasing global risk, if you will. Now, the importance of Japan and Germany is that when you look at history, particularly since long-term capital, when there is a crisis in the world that is systemic, where financial institutions are connected to each other, we don't think we're in that kind of environment. But when that kind of crisis does happen, the best defense to that crisis in an allocation is to have money allocated to a real developed sovereign. And it has to be a developed sovereign with a capacity to absorb global flows. And so it can't be Switzerland, because if you basically buy stuff in Switzerland, even though that's a very healthy sovereign, you overwhelm the market and you move it. So the deep markets for sovereign debt are Germany and Japan and the United States. If you're a global asset allocator, the defense in owning these sovereigns is the price upside that you get if there's a problem. When rates are trading at minus 31 and minus 12, as you see in this page, in order for price to go up, rates have to go lower. There is very, very little room, if any, for these rates to go lower. And so we have a situation here where often you hear people talk about the positive carry if you basically, sell U.S. securities and buy German and Japanese securities and hedge them back into your own currency, U.S. currency. But what that positive carry, when it is available, does not fully explain is the fact that there's very little upside in owning these securities, given that their yields are so low. So when you look at our 10-year yield is at about a 180 now. It's been as low as 1%. There's still upside left in our 10-year. This is a graph of the U.S. Treasury 10-year term premium. Term premium is what you get paid in compensation for not knowing the future. And so, everybody wants to earn the inflation to earn the buying power of their money. And normally, under normal conditions, this number is positive because you don't know what inflation is. So if you're going to lend out for 10 years, you want a rate where you get excess compensation over current inflation for the potential for future inflation. As you can see, there's no compensation at all. It's at minus 105. And we have not had this kind of number in the history of this series. This series was put together by the Federal Reserve of New York. It's based on a model. I've been doing this way all my life. I have not used a model as complex as this model, but I trust the model because I trust the pattern since I've lived through most of this pattern. And the thing is that normally when you see this pattern, it's basically, if you see something like this, it's telling you things are really bad and that inflation is going to go down 105 basis points and that we're going to go into a recession. But we saw from the prior pages that we're really here mostly because of what's going on away from us. The Fed has been somewhat concerned about what's going on away from us, and the issue that I have with everything that's going on in the world is that we're really the only economy in the world that is self-sustaining. Only about 14% of our GDP is due to trade, and the real issue in trade for the United States has to do with supply chains. It has not to do with cost. And so, the situation we don't want to find ourselves in is a situation we found ourselves in when we had that nuclear disaster in Japan, that the supply chain for auto parts was disrupted. We've done a lot of work on American companies, and we don't feel that there's a major disruption in supply, no matter what happens away from us with regard to China and Europe, because our larger companies have created contingencies around them for the most part, and our small and mid-cap companies don't have a lot of exposure. And so the real issue that the Fed has is that the Fed has to tell the world that it understands that there's a problem. But the reality is that the Fed cannot solve this problem because easing does not solve this kind of storm. And so much like in our opinion, much like Greenspan did before Y2K, where he let the world know that he was aware that Y2K could be a problem and he eased just to create awareness, the Fed has eased as much as it can possibly ease without overheating the American economy that is doing well, just to get that message to the world. And so, here we are, and we need to adapt to what I believe, is a new challenge, right? And the two questions that we have to ask ourselves is, how do we actually see this new challenge? What is the sign that's going to tell us that something is really going wrong? And two, what should we be focusing on in terms of our investments if we're going to do U.S. investments that will protect us for something that's unprecedented? From our perspective, the one thing, and it's been identified by the Fed, that you have to keep your eye on is business confidence and business spending in the U.S. The CEO Confidence Index, which is above 6, it's been trending down a little bit, but it's still strong. And we have the U.S. Small Business Optimism Index, which is back to the prior levels that we had. These are two very, very important indices. Normally, our downturns are that's particularly the ones that are deep, are caused by the consumer. But there have been times where the downturns have been caused by a loss of business confidence. In our lifetime, that would have been, the disaster that we have during September 11, 2001. We lost business confidence there for a bit, and we had a very shallow recession. Because if you lose business confidence and it doesn't reflect itself in the underlying consumer, which it did not back then, you eventually get the confidence coming back. As to, can we be at the end of this growth cycle? Bernanke said this, and I'm a firm believer that growth cycles are killed. They don't die of natural causes. And so I believe that we are in the third phase of the growth cycle because I believe that we're in a capital spending period. We had some major changes to our tax code that haven't fully come into play yet. And so this would have to be derailed. This trend in capital spending, I think, would have to be derailed in order for you to have a real economic problem. This is a common thing to look at when you have nothing else to look at, right? It's the equivalent of looking at foreign direct investments when you are looking at things internationally. One of the things that gave me comfort back during the long-term capital crisis that it was going to be over was that even though money was running out of Brazil, foreign direct investment was running into Brazil. So this is real spending by real companies. These three things the Fed has identified as things that they're looking at. In order to kill a recovery, you need certain situations, right? And there's three big ones. One is that there's too much leverage in the system with a margin call, and that the margin call gets executed. So you get this rolling de-risking effect. It's sort of like what happened to long-term capital, right? There was a large margin call. The long-term capital assets were not bad assets, but the margin call basically created a cash crunch, if you will. The second reason is when you basically allocate credit poorly, poor credit underwriting. That was pretty much what the 2008 crisis was about, where we allocated money to securities that we thought were AAA that turned out to be BB. And the third reason is usually that the economy is overheated and inflation is rampant, and the Fed has to basically stop the economy in order to get the pricing power of money back in line where it should be. None of those things exist right now. So you would have to have a fairly large thing happen overseas to blow back here to change reality. But reality is often perception. And so you have to worry about this perception that you see on these pages. What do you do when you don't know what to do? Well, what you do is you build the best ship you can possibly build. That's the way we look at the world. And so, when we look at this marketplace, if you're investing in the U.S. fixed income markets, you have to make sure that you're behaving like a lender and not behaving like a trader. And the first thing you do when you behave like a lender is that you want to lend to performing credits, right? And you see that there. You want the credit quality of what you're lending to, the ability and the willingness to get paid back to be very, very strong, right? So that's number one. Number two, you want the contract for lending to be structured in a way that works. What does that mean? That means that you want to be senior in the capital structure so that you get paid first. But it also means that you need a structure, because you might have to turn this into money at some point. You need a structure that's part of the system, if you will, right? That is a contract that is recognizable, easy to understand, and fungible with other contracts. What helps a lot here is owning index securities, because the securities that are in the index are structured in such a way that they are exchangeable with each other. The same thing as owning consumer loans. A credit card loan is a credit card loan is a credit card loan. And so that's an important part of the ability to turn your investment into money. The last thing is that you have to focus on investments that are supported by long-only institutional demand. And the big reason here is that institutions' investment horizons are perpetuity, and they have money. And ultimately, if you don't have an intermediary, what solves your problem is having a long-only buyer. And so we had assets during the crisis that were not treasuries that went up in price because there were buyers of those assets, right? And the buyers of those assets are institutions. A good thing to look at historically is what happened to the municipal market in 2008. The municipal market is actually dominated by life cycle buyers, by people. They have a mortality, right? The institutions are immortal. People have a mortality. Mortality causes you to run away and put your money in cash. Lastly, this is not very clear often, but you can't really diversify away credit or default risk. So you need to know who you're lending to. And so under these types of situations, you want to have your portfolio concentrated in high conviction, researched ideas, as opposed to saying, I'm going to own a little bit of everything, because owning a little bit of everything, as we saw in 2008, means that you own the problem. And, I would say that you have to be benchmark aware, because, the way that we manage money in our world is that we really set up a benchmark to be a passive solution to a problem. And so you need to behave like that benchmark if you're going to solve that problem, and you're trying to outperform that as an active manager. But you can't be a benchmark hugger. If there's a certain risk in the benchmark, you have to run away from that risk to protect capital. If valuations change, you have to be willing to change your positioning and not fall in love with hugging that benchmark. Okay, because think of this as if you're sailing in calm water, it's really easy to set the path. If you're sailing in turbulent water, you have to be basically paying attention to what's in front of you and the waves. You're not paying attention to where, to point B. You're eventually going to get to point B, but you have to get out of the way of trouble, and getting out of the way of the trouble means that you're willing to step away from exposures that are trouble. And, that's how I'll close it. Now, I will say, this sounds like really worrisome. But I will, we meet here with a lot of people that actually know what's going on in the world. Thankfully, I'm under a great firm. And, the problem here is that there's a 99.9% probability in our minds that nothing's going to happen and that everything is really, really good. No, there's no forecast, by the way, for negative GDP in Germany as we sit here that I have found. And no one in our firm has actually spoken at any of our groups about that. And so, I'm actually worried about something that has a very low probability of occurring. The problem is that if it does occur, it's going to be very painful. So if you can, if I could use another analogy, if you can't swim and you're asked to cross a river that in most places is 3 feet high, you don't have a problem. But if one place is 30 feet deep and you don't know where that is, you might not want to cross that river. And so that is the issue. We have a very, very low probability event in terms of value at risk. But that has a very, very high tail, and then the other issue is that we need to adapt to something that's new because we have no historical precedent for this, and so we need to build for future risks, not historical risks. And those are my comments for the day.